Greetings, everyone. I'm Patrick Fross with Fross and Fross Wealth Management, and welcome to our weekly market commentary for the week of December 5th, 2022. Remember that nothing said here is to be considered a recommendation, and please read the disclosures in the email to which this video is attached, or if you're watching on social media, please visit our website at frossandfross.com. Well, with Thanksgiving just behind us and Christmas weeks away, many of us are wondering if this holiday season will bring a merry market rally as it often has in the past. While we often say there is no crystal ball when it comes to investing, and past performance does not necessarily indicate or guarantee future results, history does provide us with some clues, and today we're going to go over a few of those clues. And we'll also talk about the economy. So December has typically been a strong month for equity markets. Yet those trends have been a bit weaker in recent years, so of course it's best to take things in stride. If we look all the way back to 1950, annual performance data shows us that December has been the strongest month as measured by the proportion of positive monthly returns. In fact, it beats the next month, April, with almost 4% more positive occurrences. But if we look at average returns by month for the same time period, then we'll see that December is the second strongest month, with an average return of just over 1.5%. Data shows that if the year has been volatile for stocks, as they certainly have been this year, then there hasn't been a December rally in the past. In fact, if stocks have been down over 5% for the past 11 months of the year, December tends to be flat or even down a little. However, this has been a very unusual year with both stocks and bonds both down double digits. That type of correlation hasn't been seen in more than half a century. If you remember back to July, we told you that when the market has been down more than 15% in the first half of the year, then the second half of the year has always been positive. So far, since June 30th, the S&P 500 is up 5%, continuing with those trends. Now, it's too early to tell if the other trend we discussed is also playing out, and that being that the market has been up 100% of the time 12 months after a midterm election. Well, since November 8th, the market is up about 4%. Now, as far as the economy goes, the Atlanta Fed's GDP Now model suggests that real GDP growth will come in at a 2.8% annual rate in the fourth quarter. We think that's a bit optimistic. We're penciling in a growth rate of about 1.5%. As far as the inflation front is concerned, inflation, we've been talking about it for a long time now, well, for good reason. But so far, inflation just hasn't stopped consumers from spending. Retail sales in October rose 8.3% over the last 12 months, while the consumer price index has risen 7.7% over the same time period. You've seen it, I've seen it, we've all seen prices continue to rise. And as the Fed continues to battle inflation with really the only tool in their tool bag, which is to raise short-term rates, this is going to continue to be a headwind against equity market growth. We expect the stock market to continue this trend of up, down until we see inflation lower, or possibly the Fed decides to call an early victory and pauses rate hikes. But until then, expect mediocre economic growth and continued volatility in the stock market. As we look ahead to next year, our position on the economy has been that the U.S. is eventually headed to a recession. But we're not quite there yet. Nothing in all the recent data reports changes our minds on this subject. Look for a recession to start in the second half of 2023, with some possibility of a delay until early 2024. Now, I know that R word, recession, sounds scary, and I know we all have PTSD when we think about 2008. But please keep in mind that 2008 was the Great Recession. Most recessions are mild and short-lived. Well, whether we see a recession in 2023 or in early 2024, we don't expect it to be catastrophic for equity markets. Much of this is already priced into the market. We've seen support levels in the S&P 500 around the 3,600 lows that we saw in June and in October. More data is coming. And after it starts rolling in after the first of the year, we'll start working on our live annual market and economic presentation that you're all invited to in early February. So stay tuned as we continue to update you here with these videos at the large live events or at one of our offices as we regularly meet with you in person. Well, that's it for our weekly market economic update. Once again, I'm Patrick Fross with Fross and Fross Wealth Management. Thank you for tuning in and have a great week.